Now let's go to a fun topic of I'm a smart guy and I want to pick stocks. Not me, but it is. You hear it less and less, but you still, we run into those people sometimes that are like, hey, with a little bit of my money, I want to pick some stocks. So what do we think about that in general? Is it a good strategy? And if not, why or why not? And then we can throw the graphic up as well.
That's great. And there are a bunch of different questions there. So what do we think about it? And then also, is it a good strategy? Two separate ones. I always make the joke of, if you tell me that you're going to go to Vegas to go play roulette, I'm not going to try to tackle you and hogtie you before you get on the plane, right?
Yeah.
Like if you want to do that and that's, not going to wreck you financially, right? And you get a source of entertainment from that, then like it's your life, live it, right? Is it a good strategy to go to Vegas and play roulette to try to generate retirement income? No, probably not. If you're really good at poker, I don't know. There's a few people in the world that do that, but generally that's not a good strategy. And, picking stocks is clearly better than going to Vegas. I mean, in general, stocks go up over time. Actually, the statistics, I don't have them for cut out for this video, but maybe in a future one we can put it on there. You would be surprised at how many individual stocks end up going to zero over time. It's a good chunk of stocks end up with negative returns, and a large minority of them end up going to zero over time. And anyways, that gets back to the point of why we diversify over many stocks. We don't want to put all our eggs in one basket, but the difficulty of picking stocks is very real, and we've got some data we'll throw up on this. But basically, there's an organization called SPIVA. They're the organization behind the S&P indexes that a bunch of these funds kind of track or follow. And they try to actively manage funds. These are all the funds that try to do something beyond just replicate an index. They're buying and selling stocks based on which sectors they think are doing better, which stocks they think are doing better. And time again, what you find is after fees in those funds, the majority of them do not beat the index that they're compared to. So I think at the data we have in year one, about 75% of them don't beat the index. And that gets worse and worse each year that you hold on to the active funds. So year two, even more than 75% don't beat the index. Year three, even more than that don't beat the index. And what you see happening there is, every time you make a movement in a portfolio from one position to another, you're incurring some implicit transaction costs. Then also just paying the fund managers of these funds to try to actively pick stocks. They have salaries, they have families that they got to go home and support, right? And so you start to add in all this overhead. And so it's not just that you need to beat the stock market when you're picking stocks. It's that you need to beat the stock market after your expenses, which is even harder to do, right? And so, what we find time and time again is, picking stocks in the aggregate is a money-losing proposition, right? And so that's why we try so hard to stay away from, day-to-day movements in and out of certain strategies to reduce turnover, to reduce all those extra costs, because every time we incur those extra costs, we're just raising the bar higher and higher for how much smarter we have to be than everybody else.
Right.
And so, when we think about how do we want to generate higher expected returns, go back to that example about stocks versus bonds, right? It's not controversial for me to say stocks typically return higher than bonds. Does that mean that everybody who buys bonds is stupid? No, right? Because bonds serve a different purpose. They have a different risk profile over a different time horizon. So when we're picking asset allocation, we're not saying, hey, I think Wendy's is going to do good tomorrow because they just released a new chicken sandwich, or I think Pet Boys has great new products, or I think Lowe's is going to do better this Black Friday. We're not doing that. We're saying, hey, which asset classes for our clients have better return profiles relative to their risk? And we do hope to generate better returns for our clients, but it's the same thing as stocks versus bonds, right? Somebody who is maybe a little younger could have a higher allocation to stocks in their portfolio without materially risking their financial situation, right?
Sure.
And they will have higher returns because of that. That's not us going out and picking a certain stock. That's us aligning the broad asset class of stocks with their goals. And we do the same thing as it goes down into small cap value, mid cap value, mid cap growth, international emerging markets. So that filters down to all those levels. But it's kind of a fine distinction, but it's an important distinction from going out there and saying, hey, we're so smart that we know that this company is worth something different than everybody's paying for it right now. We're saying, hey, these types of assets are better suited to our client situation than they are to the general public situation, and the general public is the one that's setting the price for this asset.
Right. Well, two things on that. One, I could see someone saying, oh, well, I see all these commercials. It's free to trade stocks now. So what are you talking about with costs of trading? Well, I don't care if the trade is free. You have just labor costs to account for, right? You're paying someone to do that. You're paying someone for their knowledge, and you're paying someone for their time to go and actually trade it. And then we can get it. You could get into the whhole bid-ask spread, which I don't think we really need to
order flow.
And all of that. So even though your trade at whatever custodian you use is free, there's still costs in there, right?
Usually, if it's free, you're the product.
Yeah, there you go. Yeah. There you go. And the other thing is, you went through this data about who beats the market. What percentage actually outperforms their index, which is very low. It struck me, these are people that are paid to do that every day.
All day,
That's their job. So don't try to do it as an individual, right?
Absolutely.
So, it's just, if they can't do it, you probably can't do it either. I'm sorry, So anyway, enough on that. Anything else to tie up there?
I don't think so. It leads into another interesting question, though, which is sort of related. We get the stock picking questions some, but I'd be curious how you answer. Sometimes clients will come to us and maybe all the tech stocks did really well last year, and so they want to invest in the tech stocks. Or, hey, real estate just got crushed, so let's divest from real estate. Or maybe it's the other way around. Hey, because real estate just got crushed, now's the time to buy. Let's go in. Or, hey, these tech stocks did really well, so maybe we should sell all of them and take our gains. So, what can you say about asset classes and how much kind of maybe last year's return in one asset class will relate to next year's return in that asset class?
This is a good one, and really for this one, I think the graphic that we have paints the picture, or sews the quilt, if you will, as good as I can even say it. But some general principles that I like to discuss with clients and with friends and things is act, don't react. So in other words, let's build a portfolio that can capture all of those markets, or at least most of those markets, so that we don't have to chase which one did what last year. And as far as the question of what pattern is there, or what reliable pattern is there, is I'm really like, there's not one.
Yeah.
Sometimes you can find one, but how do you do that? And that kind of segues into the next thing we're going to talk about. But how do you find that pattern? You find it by looking at what they've done. It doesn't have anything to do with what they're going to do. And it's also not to say that in history you can't find some patterns of things that happen. You can, but that doesn't mean that they're going to exist the next time. If they existed every time, we wouldn't be doing this. We would be trading on those patterns with our own money and be on some beach somewhere. So that's the going back to the whole quilt thing and the graphic, is that look at the graphic that we put up there, and you try to identify a pattern, and you'll see that it's completely random. And the final thing is just that's why we build portfolios, to capture the market and then tilt towards places that should increase your return over time. But it's because that there's more reliability in that, and it's more towards the middle.
Absolutely. And we were putting together this graphic, and we got a really good suggestion from Kristen, who's an advisor on our team, to actually put on here a 70-30 portfolio in and amongst all these other assets. And I'm sure we'll throw it up on the video, but you can see, every year the top and bottom performing assets are just wildly different. It just looks like a jumble of colors. But that 70-30, it's not the dead middle every year, but it's pretty close to the middle of the pack every single year. And it's intentional, right? Because it's borrowing from all those different asset classes to try to smooth out the return a little bit. And it gets back into our earlier conversation of, maybe for some people they don't need that 30% bonds because they can deal with some of the roller coaster
and even
ride.
Want it. Yep. Right. If I'm accumulating, I want more of that. Because when it goes down, I buy more of what I want, right? Just like your Apple analogy. If Apple prices go down, I can buy more, right? So if that's what I need, then I actually want the volatility. And so that's a good way to connect the two. Just kind of really riffing off of that. Is it reliable? Is it a good idea to choose things to invest in, to choose investment opportunities based on previous performance.
That's a good one. And this is interesting too, because sometimes we'll get into pretty deep conversations with some clients about what is our process for selecting funds and what do we look at. And sometimes it's somewhat surprising to them, I think, some of the things we do look at. I mean, the things we look at are, does the fund do what it says it's going to do? Does it fit into the portfolio in the gap that we have in the portfolio? So again, starting with the plan, the investment strategy, the allocation, then the funds. Do these funds fit into that area of the allocation that we need them to? Do they manage taxes effectively? Do they manage underlying turnover? So hopefully they're using the inflows and outflows from investors to minimize the amount they have to buy and sell. Because again, for them, every time they buy and sell, they're paying a bid-ask spread, they're driving up costs. So we're really looking at, when we look at funds, are you doing what you say you're going to do, and are you doing it really efficiently? Now, there's a whole other kind of school of thought or common thought out there of, well, I could go to Morningstar or whatever, I could just look at all the best fund managers from last year, and I could just pick those guys or gals, and if they did great last year, surely they're going to do good this year, right? Like in the same way that you'd say, hey, if this player, hit a bunch of threes last game, maybe he's on a hot streak, he's probably good at shooting threes, he's probably going to hit a bunch of threes this game too. And that's just not true at all in the investment world. So what you find, we've got...
Or in the basketball world.
A lot of times, it's true. We've got basically a study, Speed, the same one I mentioned earlier, does this. They track fund performance. And it's a little complicated, but basically what this graphic shows is if you take the best half of U.S. funds in 2018, so, let's say there's a big group of funds, you take the best performing half of them as of 2018, and you follow those funds for the next 5 years, and you say, hey, okay, in year 2, how many of these funds that were the best half performers in 2018 still are in the best half of performance in 2019? It's a much smaller number. You go to 2020, it's a much smaller number. You go to 2021, it's a much smaller number. By the time you get 5 years out, only 3% of those original funds that were in the top half performing funds stayed in the top half performing funds that entire time. And actually, by random chance, we'd expect it to be more than 3%, which is not really to say anything either way, other than to say, it would be better to flip coins, or just as good to flip coins to guess which funds are going to over and underperform than to look at their prior performance to see what will over and underperform relative to their benchmark. And I guess the point on that, again, is that you need to have a level of conviction in the investment strategy totally independent of the actual fund, right? Like, going back to the Apple example, like, if you had a random new kid every day and you were making their lunch for school, right? Like, some kids would like the apples, some kids would hate the apples, some kids would like oranges or whatever, right? And so it's totally unpredictable sometimes, like what's going to be rated or received the best in a particularly given year. So you really have to have conviction in, like, there is a reason that I have this thing.
Right.
And I have picked, the way that I want to invest in small cap value or medium cap growth or international. Like, I'm choosing the fund based on what I think is the most efficient way to get that allocation versus, hey, I picked the best 5 funds. One of them's a Japanese bond fund. One of them's, Polish equities. Like, that's a bad way to make a portfolio, to just say, hey, well, all these things did well last year, because in 2 or 3 years when it's not doing well, you're not going to be able to explain why are you invested in 1/5 Japanese bonds and 1/5 Polish equities, right? Whereas if you have a sensible allocation that's built on long-term data, you'll be able to say, hey, my international stocks might be down, but I understand why I'm invested in them. I have confidence in the fund that I've used to invest in them. It's efficient, it keeps expenses low, it has low turnover. And so I'm able to ride that decision out, because one of the most important things in investing is having a plan that you can stick to.
That's good. So go back to the 3% real quick, and that was over 5 years. Tell me what that represented one more time.
So over 5. So if you took all the funds, U.S. funds in 2018, and you only followed the ones that were the top half performers, if you follow those, and 5 years later you say, hey, what portion of all of you were still top half performers in every single year, 5 years in a row? Only 3% of them were. And just by random chance, you'd expect something like 6.25% to have been top performers. If you just started flipping coins, right, you'd expect about 6% of them.
Right, and that's why we're never going to take us out of it. We don't recommend to anyone to stake your entire life savings and your entire financial plan on a star manager, right?
Mm-hmm.
Or one of these actively managed funds. Base your strategy in your portfolio and your life savings. Base it on academic research, things that exist, things that have proven themselves to us over time, which we'll get into in just a minute. Base it on that, not on is Susie going to outperform this year, or is Steph Curry still going to be shooting the most threes in 5 years from now than anyone else, right? Yeah. Which that's already getting outdated. So that's a good example of why you need to have a good foundation in your plan. We're not chasing past performance. We're not chasing this person had a good year last year.
Mm-hmm. So. Absolutely.